Here's the number one question we get. What's the risk if I invest in this asset class? And here the two risks are, and there is, yes, only two. There is gross production, which means top line revenue. Every drop of oil and gas that comes from the ground times the price that the operator received at the wellhead times your undivided interest equals your yield. It's very, very simple. So I want to talk a little bit briefly about price, and I could basically sum it up in one sentence. If you're listening to this and you believe that oil will average $50 a barrel for the next 50 years, we can take this element out of the risk formula because everything that we buy, we predict and estimate that every drop of oil that comes out of the ground in the future will come out at $50 a barrel. If it comes out lower, obviously, we've missed by a little bit. If it comes out higher, obviously, we've missed by a little bit. That tends to even itself out over time. So one more slide about price. Price is controlled by supply and demand only. I know people here, I get a lot of questions and a lot of hands go up after I say that, but I'm talking about long-term price. You might say, well, other things, wars and geopolitical issues and alternative energy and winter, spring, summer, fall, hype, speculation, fear, all that, you're right. Hurricanes, all those things do affect the price of oil and gas, but only short term. And because we're buying legacy assets that will last for decades and in some cases generations, we really only want to focus on long-term pricing, which is supply and demand. And supply and demand is driven by predominantly the world population. This was the world population, a picture from NASA of the Earth, of the electrical use across the globe in 1970 when the population was 3.6 billion people. Oops, I need to update my 2018. It's supposed to say 2021, but the population now is at 7.7 billion. So it took some 50 years to double, basically, in population growth. And this is what happened when rural countries, if you go back and look right in here, look at India and look at China. If you go back and look at the way they were 50 years ago, there wasn't a light on. Now, it's lit up like a Christmas tree. And as a matter of fact, in the mid 2000s, when China was, a decade into their growth, there was a stat that came out that 10,000 cars a day hit the road in China for the very first time, every day. And all it means basically is the greater the population, the more barrels of oil and natural gas are being consumed. That's the bottom line. Now, it took 50 years to double, and that double was, 4 billion people. And the EIA estimates that by 2035, the world population will be 11 billion people. So it's going to do it again, and that's just going to increase demand globally, which should have a strong effect on upward pricing. But remember, we don't play the game. Everything we buy, we evaluate dollars in and dollars out at $50 a barrel. The next question I get is, what's the difference between the drilling program I did and buying royalty interest and mineral interest? I want to show you a few of those. Working interest is paid off of net production or net revenue. Gross revenue comes out, expenses are applied, net profit is left, net profit is distributed to the investors. You might not know how big this is, but we're paid off of gross revenue or gross production. Every drop of oil and gas, we get our undivided interest long before they apply their expenses to their net profit. Next, working interest burdens 100% of the cost of doing business in the oil patch. Drilling, maintenance, repair, all that burdens on the working interest people. Royalty interest people pay zero cost. So this asset class, these are the two things I want you to walk away with most. We get paid off of the top line, and there are no more future capital calls ever. The cash flow is one way to the investor from the time they invest to the time they sell. Next is liability. People we see in wealth preservation mode, which is really what this asset is about, burden 100% of the liability. People talk about bodily injury, tort liability, blowouts, things that happen in the oil patch that hurt people. That liability falls 100% on the working interest and zero liability to the royalty interest. So you'll never have to worry about losing your wealth in the court of law. Wealth that took you 20, 30, 40 years to build will never go away due to liability in the court of law. Working interest is considered high risk, high return. Royalty interest is considered low risk, moderate return. We'll show you how we come up with low risk shortly. A lot of people flock to working interest because of the 100% tax advantage. I strongly recommend everybody do that if they can, but just make sure that your investment creates an income stream. I get this question all the time. I get this, as a matter of fact, I've spoken several times in New York in front of hundreds of people. And one day I was speaking, and a person in the crowd, after I was going through this slide, asked a question in the middle of my presentation, and he said, "Say, let me ask you a question." I said, "Why would I do your asset class when the guy that just spoke before you said I could write off 100% of my investment against my income?" And he said, "Why would I do yours instead of theirs?" And I said, "Well, first, let me just put it this way. We're not in the business of giving tax credits, even though we do have one. We're not in the business of tax advantages. We're in the business of income. We're in the business of giving 1099s, not tax credits. So on their side, you write off 100% of your investment, and then you use the depletion allowance on the income. On our side, and we're the only sponsor that does this, we use a tax advantage the IRS allows us called cost depletion. It works just like depreciation does to real estate owners. If in a year like 2020, where our property's depleted because of no growth and production being cut back, that always happens in a low price environment. When properties deplete, and ours did to the tune of about 20%, we get to write off that percentage against our principal investment. So if you invested $100,000 in our asset and the property depleted by 20%, you can cover $20,000 of income, whether it's from our investment or any other investment. You can use it. It passes through to other investments. So our properties only produced a 5% income in 2020 because of the low price and the depletion. And so we covered that 5%. So there was no tax paid on it at all. And they got another $15,000 tax advantage on any other income that they have coming in that covered them for that year based on their investment in our asset class. So we consider working interest wealth creation, and we consider royalty interest wealth preservation. We see most of the people, the prime candidate is people who are eyeballing retirement, ready to stick an umbrella in their drink, and they want to try to figure out how to subsidize with income the lifestyle they were used to living when they were working. So they'll invest in our asset class, and we pay monthly, just like a paycheck. And they try to build their investment in our asset class to create the kind of income they were making when they were working, so that they can subsidize the life they were used to living. So there's a little bit of the difference. There's the risk.